Hi, welcome again to another presentation. We're going to start today again, like we usually do, looking at the S&P 500. Um, there's two things we're going to look at. First of all, we've had this uptrend which has been going on for several years. We basically stopped that uptrend right at the beginning of March. And you can see we're starting a little downtrend here. And there's a well-defined channel, and I'll zoom in that a little bit, but you can see that we've broken through every major moving average. We have a 200-day moving average, 150-day moving average. And that is a sign that we've lost momentum. And what that means is we've basically broken a lot of our momentum in uptrend that we've had for several years. And I zoomed in just a little bit. Hold on. I zoomed in a little bit on the past since mid-February. You can see this trend right here. We're making a new channel for the S&P. We're almost at the top of that channel. And what that means is unless we break out of this channel, we're going to continue going lower. And almost every stock in the stock market follows the S&P 500. Um, so we're getting to a point right now, this where the stock market's getting a little antsy about a slowdown in the US economy. And because of that, we have to pay attention to the S&P 500 and the levels of support that it has. It has basically broken through its major levels of support with these moving averages. And we are, we have, and we have to count on prior levels of support for bounces in the market. So right here, this is one level of support. We've already broken through that. You can see this is where it held way back in September, and we're right above that range right now. And then we have this range right here and this one down here. And I basically drew that those levels in the chart here. And we just have to watch out and make sure that if we break through that channel, if we break through this channel, then we could be okay and we're going to go sideways. But if we don't and we go down this coming week, you're gonna have some this saw pattern going downward. So if that happens, we'll hit the top and then we'll go down to the bottom and then we'll have a huge rally. We'll go to the top, and that's like a downward channel. And that means the stock market will be going down. Um, I'll explain a little bit about that later on. All right, so let's look at some of our meeting notes. Our calendar says this week is going to be quite active. We have NVIDIA GTC conference this week. That's going to happen all week long. And NVIDIA is going to be coming out with some of its latest products. And we have the Fed talking on 19th and 20th. The Fed meets on 19th and 20th. 21st, we have triple witching. The third Thursday of every month, there is a certain amount of volatility because of um, expiration of options. But this month, we have a lot of options expiring. So that's going to have huge moves in the stock market, most likely due to the settling of options for that day. All right, so you have to be ready for a bunch of volatility this week. Okay, the other things we keep in mind at the end of the month, we have end of quarter window dressing. The things performing the best this year and this month are drugs and, oh, we'll go over that later on. Let's look at that right now. Here it is. Best performing sectors: healthcare, energy, utilities, and consumer staples and materials. You can see those are doing the best. So at the end of the quarter, managers, hedge funds, and mutual funds will try to show that they're actually um, in these kind of positions. So watch out for that. And then we have earnings coming up at the beginning of April. So April, this is our quarterly earnings call for the banks. So the first week of April, second week of April, we're going to have banks. And then we're going to have tech stocks come out with their earnings. So that's going to be a big catalyst. That's another reason why April is typically a good month. If we look at our monthly stock market returns, you can see April and May traditionally are good months, and so is March. However, right now we have a situation where we have a stock market that is uncertain and not confident. And the tariffs that the president's making is making the stock market not confident, and CEOs of companies not confident to go ahead with some plans um, because they don't know what tariffs are going to be or what the geopolitical environment's going to be in a month or a year. Okay, so let's look at some of our talking points. S&P is down 1% this week. We're having momentum has basically gone out of the market. We're losing momentum. Um, we had 46% of the S&P above the 50-day moving average last week. Now it's only 23%. Same with the 200-day moving average. We didn't have 39% of the S&P above the 200-day moving average. So we have lost momentum. There's a lot of people that are getting a little antsy about this, and they're questioning how much they should have in the stock market. So you have a lack of confidence in by the average investor, and you have uncertainty for the rest of the market with tariffs. So that's yielding a very sketchy environment. Okay, uncertainty. Market hates uncertainty. With every day, we don't know what's going to happen with tariffs. Um, I should have put this in there. April, at the beginning of April, we have a deadline by the president to have reciprocal tariffs on the rest of the world. And if that happens, if that's just not a threat, there's going to be a lot of changes to economies around the world. And and tariffs in general are very bearish for the stock market. So, okay, let's go back at our look at our notes for today. All right, so okay, so we have this theme from the beginning of the year of return to the mean, um, and the healthcare, telecom, financials, energy, and utilities will do better this year. And the S&P will revert to a lower PE ratio, and we'll go over some of that later on. So a lot of this is coming true, it seems. Let's see. Okay, let's look at, okay, we're definitely oversold. We've been oversold for over a month and a half. That doesn't mean we can't go lower. If you go back and look at the financial crisis and COVID, we had a similar chart where we were oversold. But um, but right now, whenever we have a situation where the market is selling off, very similar to now, we're down 10% from the tops. We can't use this stochastics to track when to buy or sell because it's all oversold. So we have to look for other means of entry points, such as the prior levels of support. Every stock and every index has support from the past that you have to rely on for basically circuit breakers for the stock when it goes down. All right, let's go to, okay, we already talked about that. Okay, the 10-year yield is it's in a downward pattern, and you can see the stock market is going down with it. You can explain this chart in a couple words. It's basically there's fears of a slowdown in the economy, and the stock market is going down because of that. And the bond yield goes down because of this same thing. The bond market thinks there's going to be a slowdown in the economy, and yields go down because of that. And that's primarily because um, of supply and demand. Whenever you want something consistent and to ride out a recession, people buy more treasuries, and that makes the yield go down. All right, let's look at the major variables in the stock market. We see that the price of oil is down 4.5%. We've been saying for years now that when the global economy is slowing down, a lot of times the price of oil goes down because there's a lack of demand. So people in India are not going to be buying as much gas, for instance, whenever there's not as much economic activity in India. So likewise, around the world, we have slowing economies. Um, the only the only other China is stimulating their economy, so they're probably using more oil than the rest of the world. So they have a higher demand, but the rest of the world probably is um, a lower demand. But we also have OPEC and other factors involved with that. But let's keep our simple formula. Price of oil goes down, the economy is slowing down around the world. US dollar index is unchanged. Inflation hasn't changed, it's around 3%. And gold is up 5%. Um, so our formula here is a stronger US dollar tends to drive gold prices lower, but dollar has been going down. So the US dollar going down makes the gold prices higher. So that's one reason why gold could be going up. But also, there's uncertainty in the stock market and around the world. And whenever you have geopolitical uncertainty, um, there's a bid on gold. And you can see from the dollar we're in a downtrend. So that's affecting the price of gold. Um, but the dollar going down like this will help emerging markets. So, for instance, we'll talk a little bit later about China and how their economy is doing much better now. And I mean, their stocks are doing a lot better. So that's an example of, the foreign markets are doing better. And um, that also helps the big companies in America that do business overseas. So whenever Facebook and Apple and Microsoft report their earnings, they're going to say that the dollar helped their earnings by maybe 3 to 5%. All right, so fear and greed index, we're more fearful now than we were last week. So we're at extreme fear, and we could be in extreme fear for many months to come. I don't know, but right now there's fear in the market, and let's look at the AAII survey. It's bearish again. We haven't had bearish reading in the AAII survey 6 weeks in a row since the year 2008 during the financial crisis. So we're only down 10% from the highs in the S&P 500, and it's only 5% down this year total. But they're acting like amateur investors are acting like this is the worst market since the great financial crisis. But that's a contrary indicator. Usually, whenever amateurs are bearish, that's the time when the professionals come in and buy. Okay, so the VIX is getting lower, so people are less fearful than they were last week, but it's still elevated at 20. So fear is beginning in the market. Whenever a VIX turns, what VIX, what the VIX measures is the average volatility in the market. So whenever the VIX is around 20, 25, that means there's an average of 1% move in the stock, 1.5% move in the stock market every day. And when it gets down to 10, that means people are not, but well, that means the stock market doesn't move as much. It's not as volatile. So let's look at, okay, our our emotion map for investing. We're getting towards a point where people could be in capitulation mode. And basically, you'll know whenever people are in capitulation mode, whenever stocks go down in integers, and every stock goes down, and and then you have special reports on CNBC. Special report, market crash. And usually whenever that happens, it's despair time, and that's the time whenever you start buying as a contrary investor. Let's look at some of the things that could move us towards some kind of um, market correction, like a capitulation or a despair situation. Um, we have some This week. We have some news from NVIDIA. They're having a conference, so maybe if that doesn't, if that disappoints, there could be a sell-off in NVIDIA. We have the Magnificent Seven stocks overvalued. Perhaps they might go down to fair value, and that could lead. That could be from a lack of confidence in the AI story. The U.S. economy. There's a lot of indications that there's increasing odds of the U.S. going into a recession. I mentioned that last week, and we have massive layoffs, and that may slow the economy. So these are things that are, and we also have this week, we have some news about possible regional bank crisis brewing. We have commercial real estate loans coming due. So if you have a lot of people working from home and you don't have a need for commercial real estate as much as before, that could lead to a lot of defaults um, in the commercial real estate world. Um, and the regional banks could go down a lot because of that. And let me see. Yeah, we right now our gas prices are pretty under control. We have a weak US dollar, and sometimes that brings up the price of commodities. Um, let's see. Okay, we every day we have random Trump actions or words. We're gonna have tariff threats. We're gonna have tariff threats for the next at least the next year, and that could cause volatility. One thing lurking in the background is something called a carry trade. There are currency wars um, where there are some investors that borrow money in countries that have a low borrowing cost, such as Japan, and they reinvest in like a Mag 7 type of investment. And if that unwinds, then the stock market goes down a lot in a short amount of time. And as an investor, you have to like understand that it is not a fault of the companies um, due to that correction. You have to know what their true value are while it goes down. And usually the big stocks that are the highest capitalization stocks will be okay if that happens. Okay, let's look at um, okay, the Ed Yardini um, PE ratio versus bond yield. Okay, right now the bond yields are around 4.3%, and the PE ratio for the S&P is around 22. I'll explain in the next. Well, let's look at it now. You can see that the Mag 7 stocks, the biggest seven stocks in the stock market, they're starting to um, they're starting to go down. You can see they went down a lot in the past couple weeks, and that makes their PE ratio much lower. They're at 27 PE right now, and that's that's a lot lower than it was before. It was 37 at the beginning of the year, and you can see the rest of the S&P has this PE around 18 or 19. So that's substantially less, and that's closer to the long-term average of the S&P 500. So we could have a derating the big tech stocks, they could go down much more than the average S&P stock, and that could be what's happening. All right, but the average PE for the S&P is around 15, and that's still less than where it is right now. Um, okay. Okay. So let's look at the worst of first again. Um, at the end of last year, we looked at the worst performing sectors last year, and we predicted at the beginning of the year that there'd be a swap, that there would be a high demand for the worst performing from last year. And that's turning out to be true. So we have energy, we have healthcare is the best sector this year so far. We have energy coming in second. Um, the worst, IT and consumer discretionary down 13%. Um, communication services down 3%, and utilities up 3%. Okay, so it is the worst at a first. That is basically coming true. Um, in our New Year theme, investors will be reaching for stability amid chaos. We knew at the beginning of the year, Trump had like chaos on his mind with tariffs, unpredictable um, things that he would do in his office. So we have investors are now preparing for a slowdown in the economy, possible recession. So whenever there is fear and uncertainty in the market reaches to safe havens, and that is utilities, healthcare, and consumer staples. That's primarily why they're doing the best this year. We have a weak dollar, and that is going to help companies overseas and overseas markets because whenever the dollar is strong, the currency in other countries are higher. So the input cost of goods from overseas, when we have a weak dollar, the input price of goods from overseas goes up. The price of commodities also go up. That's why we see gold up 5% maybe this week. Um, okay, so okay. We also have on our mind for the New Year's themes are the government efficiency efforts. We're going to have a loss of jobs. We're going to have a slowdown in the economy because the government is not spending and it's a disruption of business models. So we have a lot of uncertainty. That's probably leading to more pressure on the big tech stocks and um, goods that are not necessary, like consumer discretionary stocks. Okay. Um, okay, so let's look at healthcare at the best, energy second, utilities third, materials, consumer staples, real estate. It's a total flip from last year. Okay, let's look at some of the stocks going up and down. Okay, market movers. We can see Ulta Beauty, Crown Castle, Palantir, Supermicro. Okay, we had a little bounce in the tech stocks because they were going down 10% in the past week and a half. So we had a little bounce in that. Um, it was basically all of the big tech stocks. You know, there was a bounce in those, and there was a sell-off in the conservative stocks, such as Kroger, A Abbott Labs. That's a drug stock. You have T-Mobile, which is telecom stock. So these top decliners are the ones that are safe stocks that eventually will probably do good this year because of the unpredictability and uncertainty in the market. Let's look at the NASDAQ best performing stocks. Um, again, these are all AI related stocks. going up. It just they've been going down a lot for the past 2 weeks, and today was just a day they turned. Um, but that doesn't mean they're going to go up more. Okay, these are all conservative stocks. They're drug stocks. They're telecom, paid dividend. Heinz is a dividend paying stock. So you can see that there was a switch um, today but these are the sectors that we've been following. These are the ones doing the best so far this year. Okay, let's look at the ETFs. We know, let's look at this chart here for the 10-year yield. Okay, we can see the yield is going down in general and the 10-year. So when the yields go down, okay, when the yields go down, yields going down. That's positive for small cap stocks, high yielding stocks, home builders, speculative, and REITs. It's negative for large caps. Well, it's not going to, let's see. So the ones doing the best are semiconductor. Okay, that doesn't work this time because it's basically the opposite. We have semiconductors, technology, regional banking, telecom. Okay, and the ones doing the worst, I mean, relative worst, consumer staples, healthcare. Okay, so this was a risk off day. So people were buying the most risky stocks. They were selling the stocks that are most conservative. And there's been so far this year, the ones I've highlighted have done the best. So, okay, that was a one-off day. But we're still in a downtrend for the stock market. So let's look at some more talking points here. Um, Look at Dan Niles picks from the beginning of the year. Um, his mid-cap ETF pick is down 4%, and his banking stock is pick is down 5%. But cash seems to be a pretty good position right now. It's up 4% because it's money markets are yielding around 4%. All right. And okay, let's read this again. We've been dwelling on this and getting updates every week, but it's becoming pretty important. If Trump succeeds in forcing through mass deportations, combined with Elon hacking at the government, firing people, and reducing deficit, there will be initial severe overreaction in the economy. We're starting to feel that fear now. This economy propped up with debt generating asset bubbles and artificially suppressing wages as a result of illegal immigration, markets will tumble. But when the storm passes, everyone realizes we are on sounder footing, then there will be a rapid recovery to a healthier, sustainable economy. History will be made in 2 years. Okay, so we're still getting hints every day that the economy is slowing, the chances of recession are going up. And so we have to keep in mind that quality companies, the ones that we're following, um, they've been through these kind of events before. And in a really bad market, we're starting a really bad market now, but when there's a really bad market where it's 20 down 20, 30, 40%, um, the big stocks can handle, this kind of environment and they can adapt and still make money. And because of that, you have um, a safety trade being the tech stocks and the ones making money. So let's look at let's look at a comment on Twitter from Bill Gross. Bill Gross is known as a bond expert. He ran PIMCO bond fund for a really long time. And he compares Trump's move to the first few months of the FDR administration, because he's basically making it. Let's read this. Because if continued, they significantly affect not just domestic policy and potential outcomes, but global economies as well. So maybe Trump's tariffs are going to be affecting other economies and making uncertainty around the world. These moves affect for now, the market volatility and business and consumer confidence globally. So if consumers cut back on their spending around the world due to this tariff problem, there could be a global slowdown. That's why we see the price of oil going down, perhaps. Okay, now he says market strategists seem to be unable to pronounce bear, but fall back on historic examples of 10% corrections and returning to prior highs. He doesn't think that's going to happen. So basically, what he thinks is we're going into a bear market now, and um, there's a slim chance we're going to bounce like we normally do. So whenever we look at this chart here of the S&P, the people on TV are saying, "Oh, every time we have a 10% correction, there's people that come in and buy, and then we're back at all-time highs in a month or so." He doesn't think that's going to happen. He thinks there's enough uncertainty and craziness in the world that we're not going to bounce this time. We're going to continue into a bear market. And he says, I'm conservatively invested in pipeline MLPs like WES, MPLX, which yield 8% tax deferred, as well as mortgage REITs such as AGNC and TWO yielding double digits. So he's buying and holding high dividend stocks. These AGNC and TWO, they yield around 15 to 13%. In their and he's been saying this for a year, and that's been right on. And MLPs, that's master limited partnerships. Um, these are stocks that basically are a toll road for oil and gas in America. So imagine America is going to be pumping more oil and more gas under the Trump administration. So they're just basically a toll collector, and there's going to be more transactions in America. So that means there's going to be consistency in MLP pipeline companies. So an 8% yield is going to be, you know, really good whenever the stock market's going down. And getting a 15% and 13% yield also is really nice. So when we looked at the beginning of the year, things that will do better are high yielding investments and safe investments. So these are high yielding. So I think this Bill Gross is really smart, and I admire what he's saying. Um, okay, here's another um, segment on Mad Money. Bill, I mean, this is Kramer. He has callers call in with different stocks to choose from. These are their portfolios, and Kramer decides um, whether it's diversified or not. Kramer's theory is that if you own a bunch of stocks, you want to make sure that they're diversified into different sectors. So let's look at our sector chart. Okay, so we have tech, consumer discretionary, materials, consumer communication services, healthcare, industrial, etc. Um, and what Kramer basically preaches is whenever you buy stocks, you put together a portfolio, you want a little bit of every sector so that whenever the stock market is doing good, you have doing good for tech, you have some of that. And whenever you have a downturn, you might have some more conservative companies like utilities, real estate, or energy. So his theory is to try to have an even balance of different sectors in your portfolio. What we're going to do is we're going to go through some of his TV shows picks. So a guy called in with Blue Owl, which is financial, NVIDIA, SoFi, Robinhood, Palantir. So so basically we have a financial Blue Owl, we have NVIDIA, which is a tech company, we have SoFi, they're a fintech, Robinhood, and Palantir. So we have um, so Kramer basically here's what do you think about this? So we obviously have three fintechs here: financial, financial, financial. We have tech, and we have tech. So let's see what he does here. Okay, so he says Blue Owl and Robinhood are basically they trade the same. They trade similarly together. So and basically all three of these stocks, they're like mem stocks. So you want he said to sell Palantir and buy Enterprise Partners Pipeline. So that brings me to our stock screen for this week. What I did, what I did was I organized, our stock screen into yield, the top yielding companies, because we're starting to look at some of the high yielding companies because that's going to do much better than in a crazy environment. You can see that there's a lot of high yielding um, pipeline companies like Energy Transfer. We have Energy Products Partners. Um, okay, and they're high yielding, and this is an example of one of those. This is a Enterprise Partners because that's this one right here, Enterprise right here. So it's yielding 6.3%. And imagine it as a toll collector like MasterCard. They basically take a toll for an amount of gas coming through their pipes. Okay, and he said sell Palantir because there was um, Robinhood and Palantir. They kind of trade together. They're like mem stocks. And so also Blue Owl and Robinhood are fintechs, and SoFi is a fintech. So he wanted to sell this Blue Owl and replace it with it's actually Bristol Myers is what he said. So you have a healthcare, you have a tech, you have a fintech, you have another fintech, and you have an AI company replaced with a enterprise partner. Okay, so let's look at another one of these. Okay, next one is Autodesk, which is a tech company. They make software for design or for architect design. You have Unilever, they're consumer products similar to Procter and Gamble. They make soap and like items. Ingalls, they're a supermarket, small supermarket. We have BlackRock, they're a financial. And we have Mastech, they're an infrastructure company. So let's see, tech, consumer products, supermarket, financial, Mastech. Looks pretty diversified if you ask me. Let's see what Kramer says. Okay, he said Unilever is not a good company. He didn't like it. He said replace it with Bristol Myers, um, which is a drug company. So Bristol Myers is one of Kramer's favorite stocks to add to a portfolio to make it more diversified. Almost every time he reaches for a drug company, he reaches for Bristol Myers. Um, okay, so let's look at the next one. Okay, next one. We have Gregory in California. He said T-Mobile, Bristol Myers, Dutch Brothers, Lam Research, and Tesla. So Tesla is a car and tech company. We have Lam Research. They do semiconductor equipment. Okay, we have kind of two techs right here. We have Dutch Brothers, which is restaurant and coffee. So we have a drug company, a telecom, restaurant, semiconductor, and car. And he says that's a perfect diversification, no changes. Okay, so the lesson here is whenever you make your portfolio, you want to make it even across different sectors so that when one sector goes up, um, you and another sector goes down, you're not going to be going down a lot in your portfolio. And so you want diversification. All right, so that was good exercise. Let's look at some of the stocks we're following and um, let's look at the performance year to date. Tesla is down 34%. Um, we have Chipotle down 16%. Apple down 12%, Google down 12%, Nvidia, all the big tech stocks are down around 12%. And you have Amazon down 10%, Microsoft down 7%. Let's look at the ones doing the best. Drugs, Amgen, AbbVie, and T-Mobile, which is a telecom. They have a high dividend. No, they don't have a high. They're a telecom company. AT&T has the high dividend. They're up 16%. J&J, a drug company. Philip Morris pay a high 6% dividend, 8% dividend. And gold. Okay, so we have our theme from the beginning of the year, drug companies, telecom, high dividend paying stocks will do better this year because they've been out of favor for so many years. Number one. Number two, there's fear in the market. So people are going to gravitate towards high dividend paying and conservative sectors. So let's see. Okay, so we have um, very soon we're going to have Trump's additional tariffs that could happen in April 4th week. So all these tariffs are making the economy um, making making for very, very difficult for investors and for managers around the world to understand what the economy is going to be in a year. And when in doubt, and when there's so much uncertainty, the stock market sells the very high valued companies and puts their money towards companies that have high dividends. Okay, let's look at some charts of interest. Okay, first chart, look at the healthcare sector. You can see at the beginning of 2025, there was a bottom, and ever since then, we're in an upward chart pattern. So most stocks in that sector are following this pattern. So this could be our new leader for this year. And we're just at where we were in November. So it's not like we've gone that far, but it seems like we're in an uptrend. We have most stocks in this sector are expected to grow their earnings 20%. So we have that against a tech sector which have a lot of headwinds. So let's look at the next. Okay, this is healthcare sector. No, this is healthcare. Wait, let's look at the next one. Next one is the Chinese um, large cap ETF, and this is the FXI. You can see this is a new leader. This is basically we've been following David Tepper's comments about buying Chinese stocks in at the end of last year, and it seems like right now what's happening is there's a lot of these stocks in this sector are undervalued. Let's look at um, let's look at the stock screen for this week. You can see that PDD Holdings, it's like a peg ratio of 0.35. That's one third undervalued. It has a lot of cash, and JD.com, it's 0.66 peg ratio. So that's another example of a um, undervalued Chinese company. So the Chinese companies seem to be back in favor, and there's stimulus in that environment. And right now, we don't have stimulus in America, and that's why China is probably doing better now. And this guy, Mark Ungewitter, says China is demonstrating global leadership, like it or not. So this could be the next sector to be doing good and next part of the stock market world. Okay, so let's look at XLP. This is consumer staples. This sector is like Procter and Gamble stocks that are paying a dividend and sell you things that are things that you have to buy as consumers, such as soap and toilet paper, etc. And they pay a dividend. So this sector is in an uptrend, you can see, and it's halfway between its overbought and oversold channels, and it's oversold right now. So this is an example of a sector that will do good if there's uncertainty in the market and the stock market's going down. Okay, so let's look at Google. The chart on Google. You can see we're at an inflection point right here. This is very similar to the chart of the S&P. So let's look at the chart of the S&P. You can see that it's following that same pattern, but it's still relatively in an uptrend. You can see the bottoms that I mapped out here, and we're basically right at the bottom of this. Google is an example of a stock that's trading at a PEG ratio of 1. That means it's fairly valued, and that could be why it's growing at 14%, and and it's holding up, it's moving at it's holding at its trend lines, and it bounced really a lot off the bottom of its trend line. But if the S&P continues to go down and makes lower lows and lower highs, then Google would break out of this beautiful uptrend it's been in for several years. So we're watching this level right here, and if Google breaks out of that, then our multi-year uptrend is over. That doesn't mean that I'm going to sell out of it. I bought Google in 2007 and 2008, and I have a lot of capital gains, and their earnings projections are still that they're growing 13 or 14% for the next foreseeable future. Until that changes, there's no reason to sell, even if even if we go into some kind of recession or the S&P goes down and breaks out of these ranges. Um, okay. Okay, we saw that. Okay, here's another note from Michael Gayed. He he mentioned that a real estate crisis is brewing. Okay, so basically we have he's been mentioning that we have this a debt issue. We have on one hand we have hedge funds that are borrowing money and buying the S&P 500. In that sense, eventually they'll have to unwind that position and all of the Mag 7 will go down. That's what all this is about, this credit event that might happen. And on top of that, he thinks that we have liquidity crisis in corporate America. He says we have now a real estate crisis. And what this means is there's a lot of people that are working from home and still working from home now that and there's a lack of demand for offices. And because of that, we have a lot of companies that borrowed money for those commercial real estate properties. And if they don't have tenants, they're not going to be able to remortgage, and they're not going to be able to pay their bills and their mortgages for those commercial real estate. And the regional banks are the ones that are affected the most on this. So we might have a crisis coming up about regional banks maybe going bankrupt and being taken over, something like Silicon Valley Bank. So we have to realize possible black swans and kind of understand what to do if that happens. So if we're presented with any of these scenarios he laid out, the market's going to go down like a lot in a short amount of time because big tech stocks perhaps or some of the banks going down. And if that happens, you have to be ready for that and know what to do. It's almost like you're playing a game of soccer and someone kicks the ball to you. You got to know what to do when you get that ball. And that's kind of, that's kind of a lot of what I do in my spare time. I like to think, well, if there was a crash, am I ready for it? And what would I do? Um, Interesting thing that's happening is Warren Buffett has been selling stocks in a major way last year. He sold half of his Apple position and he's getting ready for some kind of market correction. And whenever, some of the best investors of the world are moving towards China or reducing their exposure to stocks, you have to watch that and kind of either follow it or be ready for, any correction that happens. So we're like we're like preparing ourselves for a correction, but it doesn't affect a whole lot if you're buying and holding, and you still have quality stocks. Okay, so here's a let's look at the stock screen for this week. You can see I highlighted some of our stocks we're following here. And okay, let's look at our themes from the beginning of the year. Revert to the mean. We have healthcare, telecom, financials, energies, and utilities. I'm trying to find some interesting stocks in this screen that are healthcare, telecom, financials, energies, utilities, and possibly Chinese, because we have those are the stocks doing the best so far this year. And with the prolonged tariff nightmare, those might be the ones we could look at to do the best. So let's look at the screen. We have Alphabet. That's a that's a compounding company. They will make 12, 13% a year for the next 10 years. So right now it's a PEG ratio of 1. So it's fairly valued. They're growing around 20% according to this. My estimates are around 13% a year. All these numbers are really good. Their PE is only 16 right now. That is lower than the S&P, which is 22. So whenever the market crashes, whenever it does, people are going to buy this one on the rebound first. The stocks that are the highest quality, that are compounders that aren't affected by tariffs like Google. So we have to keep our eyes on, here's another one, Eli Lilly, a drug company. They're growing at 30%. They're a little bit overvalued. They're 60%, 1.6 times overvalued. And as an example of this, it's been sold off maybe 20% so far this year, 10%. Merck is a company it's a low PE ratio stock. Let's look at their PE. PE is of Merck is 9. That's really low compared to the S&P. They're a drug stock and pay a dividend, 4%. Here's an example of a Chinese stock, one third the price it should be according to this. Um, they're the owners of Temu, and they have a lot of cash. We have Goldman Sachs, we have Progressive insurance companies. They were taken down with the wildfires and a lot of the natural disasters happening this year. Um, zero point 0.6 PEG ratio. Goldman Sachs is zero point 0.4. And Uber, they have a kind of a monopoly right now so far in ride hailing in America. They could be, they have challenges with autonomous vehicles from other companies. You see, American Tower, they do, they pay a high dividend. Let's look at their dividend. Their dividend is, no, it doesn't show. Um, they do cell towers for companies. So their major customers are AT&T, Verizon, T-Mobile. Um, so they're almost like they have a high dividend and they're consistent demand even in tariffs. It's all a domestic company. JD, that's another company that's zero point 0.6 PEG ratios that are 35% undervalued, and they're a Chinese company too. Travelers is an insurance company, so they're 0.86 PEG ratio. Baker Hughes, they're a oil company, and the more uh, they do drilling for oil companies. So the more that Trump gives money to or gives leeway to the oil companies, they're going to do more business, and they're half price right now. And Targa is another example of a gas oil company, and they're zero point 0.8 peg ratio. So we can see whenever we're doing screens now, we're not going where the puck is right now. We're going to where it's going. We're looking to where the puck is going. So it seems like this is the ones in this color are the ones that we could be that could be doing good this year. All right, that was good exercise. Um, so let's go back to where we were here. Okay, that's all I had to say for today. I hope you enjoyed the talk, and I'll see you next time.